It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm Paul Peebles, your host for Ask Mike Mondays. It's Michael Becker. Michael, how are you?
Hey, doing good, Paul. Back from a little summer hiatus. How's everything in your world?
It's going great. It got even better in the last, 72 hours. Last time you and I were together on the podcast, interest rates were at 465, 470. Today, the 10-year, they hit 379, 380 yesterday. Now they're up a couple basis points today, but unbelievable jump down from rates from where they were to where they're at today. We need to stay off the podcast more often. Hopefully they go even farther down.
I'm sure the listeners would take that bargain. I'm sure.
I'm sure that they would like that bargain. So Michael, tell us a little bit about what's been going on over the summer, whether it's you personally or you guys over at SPI, about what's going on. Tell us a little bit about what you're seeing out there.
Yeah, it's been busy. We, got a lot of stuff going on, refinancing a deal right now. We sold a property at the end of spring, early summer. Got another one in escrow to sell. Bought two, buying another one. Trying to get some more going too. So just everything and all between, reevaluating the entire portfolio, seemingly to see if anything might work for a refinance right now. That 10-year treasury, 5-year treasuries are down quite a bit. So it's been busy. I think the market is starting to kind of heat up. We kind of talk about some of the things I'm seeing out there, but starting to, been seeing kind of the light at the end of the tunnel get a little brighter and brighter every day that passes.
Yeah, talk to me a little bit about what's been going on, really. I mean, you guys have purchased a couple deals. You're in the process of selling a couple transactions. You guys sold one back in May going to June, I think, and then you're selling one that's closes sometime at the end of August, beginning of September. You're looking at several deals. Give us a little bit about what your flavor is and temperature of the market itself. Are you getting to be aggressive? Are you guys buying distressed assets? Are you buying older assets? Are you buying newer assets? Kind of bring everybody up to speed about what you're looking for out there.
Yeah, I mean, we're primarily focusing right now, Paul, kind of on Austin and Dallas, which are kind of our two main markets, Lesser and San Antonio right now. And really kind of what my read of the market right now is generally the better relative value in my eyes as we talk right now are kind of newer assets in Austin and older assets in DFW. So kind of what I mean in Austin, there's a lot of headlines, so it's no surprise anyone that's probably paying attention. There's been a ton of new supply being built and delivered, and there's still kind of a wave in the process of being built and delivered. So right now, a lot of these developers are hurting. They're needing to clear a lot of these deals, and you're starting to see some pretty compelling basis that you can buy some of these deals at. It's tough to raise equity in Austin. The fundamentals are soft, rents are declining, vacancy is up. So, those are kind of all the headlines you read. They're real. So right now, a lot of these developers got to kind of clear these deals, and they're significantly below kind of current replacement costs. And that's kind of what is available in the marketplace right now. The buyer demand for it is just, softer just because there is, equities it's hard to get equity buy off on that right now. So that's what we're seeing kind of in Austin. Move up to Dallas, and Austin don't really have a whole lot of workforce housing relative to, say, Dallas or Houston. They didn't build as many apartments in the 70s and 80s in Austin. So a larger percentage of the apartment stock is younger and vintage than relative, say, Dallas or Houston, which has a pretty large percentage of their apartment block that is from the 70s and from the 80s. So jump up into DFW, where you're seeing some Class A deals trade at a pretty compelling, pretty low cap rate still, all things being said, and selling. Occasionally you see a couple deals kind of below replacement cost, but they're kind of generally at kind of current replacement cost, which is a marginal profit for a lot of these builders. It's a little tougher to make sense of your brand new Class A stuff. A minus you can make some sense of in spots, but that's also very, very sought out part of the marketplace. A lot of these people are looking for a story, a value add. There's not in the Class A. There's no story in Class A. There's no real distress or discount in Class A in Dallas, because on a percentage basis, the market's in much better shape for new deliveries relative to the overall market versus, say, Austin. So kind of your 9-foot ceilings, newer construction, fire sprinklers, better quality construction from stuff that's maybe 15, 20 years old. That's getting some attention. So you're seeing those cap rates still stay pretty compressed in the kind of low fives, I would say. And, if it's the right deal and the right location, it can even have a four handle on it. But what is a little bit less out of favor is as you go kind of down spectrum, well-located B deals are still getting some pretty good attraction. But if it's a B deal that's maybe a little lesser located, a little higher crime area, or you get into your 1970s, kind of your C deals, those tend to have, much smaller buyer pools, especially if it's a larger deal. And the historical or recent history had a lot of kind of your apartment syndicators buy that type of product, and those guys simply can't raise money. So even if they want to, they don't feel comfortable they can raise it. So that's kind of where I think the relative value is right now, a little bit older. So trying to be selective in what we look at with that kind of general tent on the view of the world, Paul.
That's the fine print. Let's go back to the headlines that everybody wants to know. What are the brokers, the listing agents, the investment salespeople? What are they saying in Dallas, and what are they saying in, say, Austin?
Austin, bring an offer, anything, you can't insult me, get in the mix. My phone's ringing. We're been pretty active there and try to remain active. I think there's going to be anything we bought last year, this year with a little bit of hindsight, it's going to look really smart. At least that's what I keep telling myself. I think, it's pretty compelling relative to where the value is. Right now, Austin is cheaper than Dallas. It's got a higher cap rate, the price per pound, all those things. And that historically has not been the case for most of the last, 30, 40 years. Austin's always traded at a premium, at a lower cap rate, at a higher price per unit than Dallas. And it is backwards right now. And so that's kind of the compelling moment in time that we're here today. And I don't know if that's there tomorrow type of thing. So that's kind of what you're hearing. And then on the Class A, if you don't jump on at A kind of A minus, then brokers have plenty of interest and they're clearing deals. Talking to one of the brokers from the largest shops, or one of historically the highest volume shops in town earlier today, and he was mentioning how in Dallas, KKR and what was the other one he said? KKR, Blackstone, Equity Residential, a lot of these like large institutions have transacted in the last 30 days in Dallas. So these institutions that, if you go back and listen to podcasts from a year ago that are all pencils down, pencils back up, right? So they're not only looking at the deals, but they're actually have purchased and transacted. You've seen some headlines from the prior few months about Blackstone buying a large REIT, KKR buying a REIT. So these are apartment REITs. So you're seeing them come back in a pretty big way. So they're game on again now, Paul.
Let's talk about the headlines in capital markets. You guys have closed a couple transactions. You're looking to refinance a couple, buy a couple, sell a couple. Tell us a little bit about what you're seeing of the capital markets. What type of product are you guys looking to do? What types of leverage are you finding out there? Let's kind of give big strokes.
Yeah, I think it's pretty robust. So it's back. The agencies are pretty competitive. Spreads. So when you pay when you get a mortgage on commercial mortgage, your rate is a combination of the index, the treasury, typically 5, 7, 10-year treasury plus a loan spread. And so the spreads have stayed pretty tight. We're able with a little bit of a buy down to get around 1% spread with a 1.25 buy down on a 5-year deal. So the 7-year treasury is at 380. Your all-in rate would be about 480. So, we're able to get some deals sub 5% right now. We actually locked a deal sub 5% this week or last week, whatever. I lose my week. I think it was last week. So we're seeing, 4 handles on our interest rates. Well qualified sponsor, obviously. These are in the 65 LTV bucket. If you're in the 75, 70, the spreads are wider. If you don't buy the rate down, the spreads are wider. So maybe kind of generically mid to high fives would probably be generic rack rate, I would say, in the marketplace. I don't know if you have a difference of opinion, Paul, for agency loans, but it seems like that's kind of the rack rate.
Yeah, what we have seen recently in the last, say, 72 hours, were because these interest rates have come down so much, we had a bunch of loans that were locked at a higher rate, and it would have been not a problem if interest rates went even higher, because you lock in. But when you have the market fall apart where interest rates where the 10-year treasury, the 7-year treasury goes down. And now we're down about 50, 60 basis points lower in terms of the index. Everyone says, well, what's the interest rate now, Paul? Can I get a lower rate? And I have to remind them, no, we locked 2 weeks ago when it was at X. We cannot break that lock and go down to Y. So it's been dynamic conversations that we're having. But I will tell you today, Michael, we had a deal with the Freddie Mac small balance that we locked this loan, I think 2-3 weeks ago. And through one of our relationships, they never do this, but they were able to relock this Freddie Mac small balance loan. Because what usually happens in the Freddie Mac small balance loans, usually for transactions between $1 million up to say $7.5 million, and you can lock it up to 35 business days up front. And so once it's locked, it's locked. But in this case, I don't know how they did it, but we were able to not just break the lock, but we were able to bring that interest rate down on this particular transaction about 25, 30 basis points lower than it was before. So the bird in the hand right now is great if you're in a position to rate lock your deal. But if you're just coming into the relationship to refinance or buy, it could take you 2-3 weeks to get a deal teed up, have it underwritten, have the third parties complete. And then with Fannie Mae and Freddie Mac or so, at least with Fannie Mae, you have to do an early rate lock, a SERL. That you can do an early rate lock probably about 2 weeks after you get from the point of application to get that going. But who knows where interest rates are going to be in 2 weeks from now. But if you're all teed up, ready to go, it's not a bad deal to be in your shoes. And especially if you are like Michael and have a great relationship with the agencies, it's an unfair business, as Michael says, and I agree with him, that you can get better pricing when you're a good sponsor like Michael and his group at SPI. What do you think being a good sponsor like what you guys are, what does that save you? Do you think on a per transaction basis? Is it dollars that saves you? Do you get more loan dollars? Do you save the cost? Where does it come in that they respect you?
Probably 10 to 20 basis points generically, and more IO, more interest only. I think they'll give us that. They'll give you the benefit of you'll get some exceptions, maybe underwriting at a 35-year amortization versus a 30-year amortization to push the loan dollars from time to time. So you'll get some waiver just by having successful track record in history and, willing to step up and solve some problems when times were tougher, and then get the benefit along the way on newer transactions as well. So that's really where it kind of comes into play.
But you didn't start off doing that. You started off doing what?
Rack rate, 10-year fixed rate, 1-year IO, full rack rate, right? I mean, we didn't get any special breaks. That stuff, it's just trust is earned over time. That's kind of what it is. Just repaying hundreds of millions of dollars of debt over the years to each of the agencies gives you a little bit more street cred than doing your first or second deal.
Let's talk a little bit about investors' expectations these days. You talk with your investors on a daily basis about investing in some of your deals, and then you're operating the properties, and those people get distributions, and they get paid back, and hopefully that they'll bring the money back in on another opportunity. What's the attitude right now? What are you hearing from, say, some of the investors over at SPI, and what's their attitude about investing back in apartments?
Yeah, it's mixed right now, no doubt. I mean, that's kind of one of the things that, still hasn't come all the way back is, kind of confidence and sentiment. People that are in deals, I mean, some of the deals have distributions off because there's an adjustable rate mortgage, and you have a rate cap issue. The escrows went through the roof, and now I think the market's in the process of unwinding that. That was a pretty steep cliff that we've all been climbing in the last 24 plus months. To kind of, it's kind of like climbing Everest. I think we all climbed Everest on the rate cap escrow. And so that's kind of like reversing in real time, Paul. So that's been tough. Then, most of these investors invest not just with me, but with other people. So maybe they have a deal that they potentially get lost or threat of losing, all outright, if they had a bad structure and over levered and a workforce housing deal that they bought at the peak. A lot of those deals have some real distress, and even these decline in rates, I don't think are going to save a lot of these kind of deals. I think the kind of baked in the cake, just a matter of when, not if they kind of go sideways. So there's some of that out there. So a lot of negative sentiment out there, but it's also mixed with everyone seeing opportunity. We bought a couple deals in Denton. We had one equity partner provide us the vast majority of the capital on the deal. And the prior guy, unfortunately for him, he bought them the wrong time. Did a pretty good job renovating them. Moved revenue, over 30% in his ownership period upwards, and he still lost the bulk of his money when he sold the
Wow.
deals, is because cap rates expanded, and he just didn't have the time or didn't want to put the money in to get the time he needed to have the market correct. So those deals are kind of starting to clear the market, where the market was completely frozen in 2023 for the most part. Starting to see some of those clear, and those were older deals, so we kind of dipped our toe back into workforce housing, and those deals qualified. If we wanted to, we could have got 80% leverage. We ended up taking 65% leverage and getting a much lower loan spread and full term interest only. So that's what we ended up doing. But I've kind of told myself, find some quality older deals that are in good submarkets, and the deals can qualify for 80% Fannie Freddie kind of agency financing. That's probably a pretty good cheat. That is a good time to buy. So you can overthink this business, or that's a pretty good tell that it's probably a pretty good price.
Let's talk about management and what you're seeing out there. How are these properties occupied? Are they 100% occupied? Are they 90, 80? I mean, what are you seeing in some of the properties that you guys own, and what is the market showing?
Market stabilization is 94, 95. Historically, you're a couple points off. You're 92-ish, some deals more, some deals less. So you probably got 200 to 300 basis points of more vacancy than you historically have. With the higher vacancy, you also see flat, just single digit, low single digits, 1-2% kind of rental rate growth on renewals. And then depending on the market, you're seeing negative trade outs on new leases generally across the board. So you're seeing rental rates kind of go, mildly backwards, kind of net. Austin's tougher. Dallas is probably flat, slightly positive right now, net, and Austin's definitely going backwards. We're seeing that kind of sure up. I think maybe we're kind of I think we maybe have found the bottom when it comes to rental rates, and we're starting to see occupancies kind of rebound. But, we're here in early August as we record this, and we need to, by the time September is over, we need to be, 94, 95, or it's going to be a tougher fall and winter. But what we are seeing, and what's kind of like the light at the end of the tunnel, is we talked about the rates are kind of coming down. So that's really helping sentiment. That'll help anyone that's got a floating rate loan on the margins. It'll help the interest rate cap costs come in quite a bit. The higher strike you have on your interest rate cap, the more material the savings are going to be on your replacement cap, and then the corresponding escrows. So that's going to be helpful. And then, what we're seeing is supplies kind of, I think, peaked, certainly in Dallas, and is either peaked or about to peak in Austin. What we're looking at, and probably many places across the country, as I've repeatedly talked about on this show and in my newsletter that we write, that, ever since Silicon Valley Bank and First Republic failed in March of 2023, it's been very difficult to capitalize and finance new construction projects, and all the equity that historically has financed new construction projects are now looking at like buying new construction at a discount to current replacement costs. So, they're much more interested in buying that right now. Why take the development risk and lease up risk when I could buy it below what it's going to cost to build it, and I don't have to, I just got to maybe lease it up or take a little lease up risk or a little bit of market risk. So that's kind of diverted a lot of the equity's attention to buy kind of new construction that have historically financed kind of construction financing. So, like I've talked about several times, that in Texas, garden product takes about 24 months from kind of breaking ground to build, and wrap construction, structured parking, elevators, takes about 30 months. So, we are 17, 18 months past Silicon Valley Bank failing now. So, you kind of get into Q2, Q3, there's going to be just a cliff of supply dropping off. And I think we're starting to see the beginnings of that. There's less and less supply delivering. A lot of these deals have delivered, and they're kind of slow instead of getting leased up. And we're going to wake up next leasing season, and there's going to be a lot less competition. So I really think rents really firm up, in particular second half of 2025. I think 26 and 27 are going to be two really good years and for rental rate growth. And I'm not alone. So I think I start to draw the institutions off the sidelines, draw some of the private equity firms, the private guys. Everyone's kind of seeing lights at the end of the tunnel. Now the debt's getting a little easier with rates falling. I think, the bottom's in. The bottom was when the 10-year treasury hit 5% in October of 2023. That was the bottom. Now
Yeah.
we're kind of coming off the bottom, especially in the Class A space in particular.
Somebody that's maybe coming into this space that's never invested before and kind of wants to just kind of get your 2 cents about the market. If this is a moment in time to start investing in. So, but the question I really have is why invest in apartments versus the other food groups of industrial or warehouse or, all the different, retail things. Why multifamily? Why is that probably the better piece to get into?
Yeah, I mean, I think, or what I like over, say, I mean, obviously, office is maybe just impaired forever, or at least for a long time, just with the shifting trends of how people work from home and remotely and all that. So obviously, there's many headlines about the bloodbath. What I never liked about office is what I learned the hard way when I was a banker back in 7, 8, 9. We had a couple office loans, and then we had to take them back and realize that they're very capital intensive, and that also goes for retail as well. They're very capital intensive. So every time you have maybe you have a 8 or 5 to 10 year lease with a tenant, when a tenant moves out, or even if you have to renew them, typically speaking, you have TI and leasing commissions. So tenant improvement allowance and leasing commissions. And so every time, maybe you get a 10-year lease at, $30 a square foot, but you got to give them, $30 a square foot in a TI allowance and percentage of the life of the income stream as a leasing commission to the broker. So it might take you the first 2 years of revenue to pay for TI and leasing commissions before you even start making any money. So it's real capital intensive, and then your vacancies tend to be a little longer. They also don't get as favorable financing. They don't have Fannie and Freddie. And they have less attractive depreciation schedules. And there's just several things that are much less attractive when it comes to those. Industrial obviously has been a darling with kind of office losing and retail losing a little bit, and e-commerce kind of being a bigger thing as a trend the last 15 or so years, even though it seems like the retail's been under delivered. They haven't built a whole lot of retail ever since 08, 09 kind of really went bust. So that's probably in a much better shape. But those are some of the things that why multifamily is better than those, Paul. And then just kind of demand. I mean, there's this more and more population. People are, especially if you're in the high growth area. So we don't have a demand problem. Even in Austin, Texas, they're absorbing a ton of units. It's a temporary supply issue. But with the issues with Silicon Valley Bank, First Republic really kind of bringing to light some of the fragility in the community bank, the regional bank system, stopped a lot of the construction for those. Today's oversupply is setting up tomorrow's undersupply. And like I said, I think everyone's kind of looking forward that in less than 12 months from now, that's going to be completely flipped. And 26 and 27 should be some, 2 banger years for rent growth. And you can't just snap your fingers and turn supply on. So it's going to be, maybe you have some deliveries in 27 that start catching up, but there's going to be virtually a much meaningfully lower number of units delivered in 26 than kind of historical norms. So I think you're going to see some pretty good rental rate growth playing catch up. And if rates fall at the same time as rental rate growth is exploding, I think you see cap rates compress, values go up, and it's game back on. So, can you, we've said before, my theory the last few years is you got to, buy deals in 23 and 24, survive till 25, you're going to thrive in 26 and 27, and go sell in, 28 and go, F off and do whatever you want to do, because we're going to make so much money on the deals that we have the courage to go buy when others wouldn't.
If somebody that maybe has never invested in real estate, maybe they bought a house, but maybe they bought a rental property. But if they're thinking about getting into stocks and bonds, and they can look at some analyst, his recommendation is saying what to buy on, but they buy NVIDIA. They can understand that. But when people want to get into multifamily and to invest in multifamily, what do you suggest that they read or watch? How do they get smart in this business? And then how do they trust some of these operators that they know what the hell they're doing, and how do they vet these people out?
Well, I think if you're going to be alive in a couple of years, and you've been doing deals before and after the last 22, 23, 24, it's going to shake out a lot of guys. So, So if you're looking at guys that made it through those, I mean, I don't think if you've been doing deals throughout this cycle, you're not going to have some level of issues where you didn't have this problem or that problem. But did you lose deals? Were you able to kind of come through it? Were you able to work out everything that you had and get on the backside? Because time's your friend in this business, generally speaking. You just got to kind of get through some of the leaner years. And I think we're through the bulk of the problems of the business. So if someone was doing deals and, before COVID, and they're doing deals, in 25, 26, if they probably made it through, right? If they're consistently buying throughout that process. So that'd be a good thing to look up in a couple of years if you're looking at people to potentially do business with. I mean, right now there's a lot of opportunity. So do you have the courage to actually, put capital out when the opportunities are the best? That's usually when it's kind of counterintuitive and people clam up or, are allocated or have other problems they got to go fight. So it's easier said than done in real time. And that's, evidenced by the transaction volumes being, way, way down. But, think education, listen to certain podcasts. People have been around, have been doing this a while. That have kind of, taken their lumps and learned what to do and what not to do. I like one of the books I read that, after I was investing in apartments, I thought did pretty good. Kind of a friend of mine, I mean, not super tight, but Ken McElroy wrote a couple books, the ABC of Real Estate Investing and the Advanced Real Estate Investing Guide, I think what they're called. I think his business model is pretty closely aligned to what we have done at SPI. So I think those are pretty good books. I'm not the biggest reader, Paul, but I think those are pretty good. Just guys, some gray hair. They've been around a cycle or two, and I think those are guys kind of listen to. I think go to the Old Capital Real Estate Investing Conference, which is coming up. You can give a little shameless plug here and watch the rocking chair panel. The guys that have been through a few cycles. That'd be good guys to listen to.
Yeah, absolutely. So thanks for shamelessly plugging the Old Capital Conference coming up at the George Bush Museum in Dallas, Texas. I mean, we're famous for our venues and our speakers and really just networking. So we're not here to sell you books and tapes or get you into a program. We're just here to have you understand a little bit about what's going on in the market today, just like conversations with Michael here. But, think of it on to the next level of listening to general partners and what they're talking about, up to the moment, what they're hearing, lenders about what they're talking about, what they're approving, what they're not approving, the problems that they're working through, property management companies, what's going on. How do you keep these properties going if the partnership has no money to keep them fed and keep the money coming in to maintain the property and pay the personnel that manage your asset? So, but the biggest thing is really networking. You definitely want to come and get to know some of the people there. If you're thinking about investing or if you're thinking about trying to sponsor a deal, that's the Old Capital Conference. In a nutshell, again, we're not trying to sell you books or tapes. We're trying to make sure that you're up to speed because Michael and I don't want to see anybody lose any money. So the best thing is kind of figure out what little bit of group think about what the market's doing to be ahead of that big wave. Go to the oldcapitalconference.com, oldcapitalconference.com, and we'd love to see you in Dallas, October 9th and 10th, and we'll see you then. Michael, I'm going to throw that shameless plug back to you. Tell people again what you do at SPI and how people can get more information.
Yeah, they want to learn more about us, just go to our website, which is spiadvisory.com. That's SPI like spyadvisory.com. There's a contact us form there. We do a quarterly newsletter, obviously podcasts here with Paul, get on our distribution list as we put out opportunities. But kind of in ending, I think there's kind of light at the end of the tunnel. We've been talking about this for a while. We've been consistently buying deals through, last year, this year, a little slower this year than I would like, but hopefully get a syndication or two out in the not too distant future.
Well, you guys were like number one last year, right? We
were in the top handful of buyers in the state of Texas for sure. And we consistently try to buy this year. It's been a little tougher to kind of get some traction going, but I mean, there's still plenty of opportunities, but I think it's a little bit of a burning match because rate cuts are likely seemingly a mortal lock here in September, if not before. They don't panic cut before that. Treasuries are front running it. So I think everyone's kind of seeing the all clear lights at the end of the tunnel on rates. Not only do we confirm they're not going to go from 5% to 8% or whatever on the 10-year Treasury, that now the next move is lower. So I think we're going to see that kind of open up quite a bit more interest now that it's kind of a little bit of an all clear signal. Supply is dwindling. That's like a also a burning match that's us getting closer and closer to burnout. Like everyone sees rental rate growth in the future. It's a little tough right now with kind of maybe a little uncertainty with the election, but that'll be in the rearview mirror in 90 or so days now as we record this podcast. So a lot of dominoes are starting to fall. So if you wait for the all clear signal to be fully all clear, I think you're probably going to see a 5-10% jump in pricing. So, again, I think we're seeing value in newer stuff in Austin and older stuff in Dallas. I think there's a lot of zombie deals out there, a lot of dead bodies that haven't fallen in some of the older workforce housing space. And then we're starting to see a couple of those drop. So we're trying to pick up the better quality ones of those. We're not trying to look for any sort of dumpster fire, bad location, terrible physical shape, anything like that. We're trying to be selective as we kind of go back in time and buy some of those older assets. So I think that's probably going to be in the mix of deals that we do a little bit more frequently than it has been the last 7-8 years. Because if you go back in time, and obviously we're not perfect and we've not done everything exactly right. And I have the list of things I wish I would have done different is long like everybody else. But one thing we generally got right was we maybe a little early, but we saw when the cap rates were 350 basis point spread between the top of the grade and the bottom of the grade in 2013 when I bought my first apartment building. And when they compressed where they were like a 0.5%, 50 basis points, 100 basis point apart at the peak of the market in 21, 22, it didn't make any sense to pay the same or similar cap rate for an old deal as it is a new deal. And as the market's kind of corrected, the cap rates have been much stickier on the top of the grade, and they've blown out a lot more on the lower end of the grade. So you're starting to get paid for the risk of the older deals again. So, trying to be selective and not buying in bad locations and all those kind of, don't buy in the hood and all those rules that we talked about for years and years that we can maybe do a refresher on the next podcast, Paul. But
Sure.
I think those are the things, and there's some opportunities. So if you're fortunate enough to have your back clean and not be in a bunch of bad deals, now's a pretty good time to be buying. So I think those that haven't participated in this space, I think is a pretty good entry point. And I think that the deals are going to get, economically thinner and thinner as we go through the cycle.
Got it. Makes sense. All right, Michael Becker, let's not have so much time go between the last podcast and the next podcast. So we certainly do appreciate it, unless the interest rates go down another 50 basis points. And then
I think everyone will take that bargain.
we'll push it out as far as we can. Again, Michael Becker with SPI and Paul Peebles. Have a great day.